They say that the company is trading 63% below its estimate of fair value. And they say that the earnings are forecast to grow by 38% a year. There are some negatives that you see here. Shareholders have been diluted, profit margins are lower than last year, insider selling over the last 3 months. Let's assume you have a gold mining company, and I'm talking about gold, it could be silver, and the gold mining company digs the gold out of the ground at a cost of $2,000 an ounce. It sells that gold last year, let's say at a price of $3,000 an ounce. So what's its profit? Its profit is what it sold it for, $3,000 minus the cost of digging it up, $2,000. So its profit is $1,000 an ounce. But this year, let's say the price is $4,000. It's gone up $1,000 from $3,000 to $4,000. So they're still digging the gold up at $2,000 an ounce in terms of the cost of digging it, but they're now selling it at the market price of $4,000. The gold price is a bit higher than that now. So it's the gold mining company digging it out at $2,000, selling it at $4,000, is making a profit of $2,000 an ounce. That's a 100% increase. It's doubling the profits that they made before. Last year at 3,002 they made 1,000, and 4,002 they make 2,000, so the profit has doubled. But the gold price only went up from 3,000 to 4,000. That's a 33% increase. But the 33% increase produced a 100% increase in the earnings per share of that illustrative company. The point is, any change in the gold price has a leveraged effect on the profits of a gold mining company. And that works in both directions. So assuming the share price follows, when the gold price goes up, you can expect the shares of the gold mining company to go up faster. And indeed, that's what's happened this year. Many gold mining companies have seen their share price increase by more than 100%. So keep your eye out, don't be frightened of buying companies when the share price is already up. And I'll talk about that in a minute. But just as a generality, all the companies I'm going to choose today, they're all large companies, so there's a relative degree of stability, safety. They're all profitable, which is something I personally like. Now, you can make more profits if you buy a company which is prospecting for gold, has got a lot of gold in the ground, but not dug it out. And the reason for that is there's a lot more risk with those companies. So when they get it right, the potential is very, very large. But the risk is also much larger. That's why I tend to choose companies which are already profitable. And in every case, these companies are forecast by the consensus of the analysts to increase their earnings per share for the next few years, as well as their precious metals output.
The same leverage that boosts profits in bull markets works in reverse when prices fall. If gold drops, mining margins shrink far faster than the metals percentage move. That volatility is why mining stocks frequently swing more dramatically than gold itself. Yet many established producers remain attractive because they've already reached profitability, manage efficient operations, and maintain strong balance sheets. These companies typically carry less risk than speculative explorers whose futures depend on undiscovered deposits. While explorers can deliver extraordinary upside, they also face higher failure rates. For long-term stability, many investors prefer established, profitable mining firms.
The way we're going to do that, we're going to go and look at the program simplywall.st, and here we are in it, and we're on the dashboard here, the dashboard on the top left. I'm going to move across to the screener, and I'm going to click on the screener, and now you can see that I've already put some parameters in. I put a health score of 4 out of 6 here. I can pull that in and out. And I put a future score of 4 out of 6. I don't go to 6 out of 6 because we wouldn't find any companies, at least not with the other parameters I put in, which are the markets, the industries, and the metrics. Under industries, I've chosen only 3 industries to look at, so no companies which aren't in these industries should show up. I've chosen precious metals and minerals, silver and gold. Lastly, I put in certain metrics, and I'll just talk through them. The first metric is I only want to look at companies which have a 1-year return, a share price increase of at least 80%. If a share has gone up by above average, it means there's a lot of people missed the boat and they would like to buy it if it drops back. There's also a lot of people who can see good things about the company. These are the good things I'm seeing also, and that's why they've been pushing the share price higher. And I'm expecting that in the future, more people will see those good things, pushing the share price even higher. It's not guaranteed, and it's not investment advice, but I think that's likely to happen, or more likely than not. So 1-year return, at least 80% up on the share price. I'm also looking at large companies of at least 5,000 million, that's 5 billion. So these companies have a market cap of at least 5 billion or more.
To identify potential leaders in the sector, analysts increasingly rely on data-driven screening tools. One example is Simply Wallsaint, an online platform that breaks down company fundamentals into easy-to-compare metrics. By filtering for financial health, growth expectations, and industry type, investors can quickly narrow thousands of firms to a manageable list. Setting parameters such as large cap only, precious metals sector, and earnings expected to grow 20% annually helps isolate companies with sustainable momentum. Adding a requirement that shares gained at least 80% in the past year highlights firms already demonstrating strong market demand and operational execution.
And here's the most important parameter I'm looking for. I'm only looking at companies which are expected by the analysts to increase their earnings per share by at least 20% a year for the next 3 years. In other words, I'm looking for growth companies. So 20% a year, earnings per share increase for 3 years as forecast by the analyst. Of course, I have done my own research after that. You don't just rely on what other people say, or even on what Simply Wall Street says, which we're going to look at in a second. You have to do your own research. But anyway, having put those filters in that you see here, it's come up with 20 results, 20 companies, and we're going to look at just a small number of these which I have picked out. But I have looked at all of these 20, which you can see scrolling here. In my opinion, there's no bad ones here. There's just some which stand out more than others, and it's the ones which stand out more than others that I think are the best. Now, you might not agree with me, and you might find some better ones with a different set of parameters, or even with the same set of parameters, but I'm going to show you from this list which ones I think are the most attractive. As I say, I haven't bought or sold any of these companies in the last 3 months to my knowledge, and I am not intending to buy or sell any of these companies in the next few months. The first company to look at is called Alamos Gold. So I'm going back to this stock screener, and we can see that Alamos Gold is here. I'm just going to click here and we'll find some information about it from Simply Wall before I look at the website. According to simplywall.st, Alamos Gold is trading 77.9% below their estimate of fair value. And according to them, earnings per share are expected to grow by 23.38% per annum. Let's look at the website and I'll tell you what I have discovered about Alamos Gold. So we're on the website and we'll go to the basically information about it. Let's go just have a look at this page here. You can see it's quoted in Toronto and on the New York Stock Exchange. So you can buy it in Canadian dollars or in US dollars.
Applying rigorous filters often yields a shortlist. Here, roughly 20 mining companies met the criteria. None were bad, but some displayed particularly compelling catalysts. Analysts examined market value, production costs, operational risk, and expected output growth. They looked for firms positioned to expand volumes while benefiting from rising gold prices. Companies with robust cash reserves, low debt, or major new mines coming online ranked especially well. The process also considered analyst forecasts for earnings per share over the next 3 years. With gold above historic highs in 2025, firms capable of scaling production are attracting heightened investor attention.
I'm going to talk generally for a second or two about the prospects for the company and the reason why I think it's going to go a lot higher. The main catalyst will be the ramp up in production of one of their mines, which is called Magino, and the increasing gold production, which is going to come from that mine. Now, Alamos Gold is cash rich. It has no debt. So it's ready to go. It's got the money to start mining. It's going to take the production from below 500,000 ounces a couple of years ago to over 1 million ounces by 2027. So that production is going to rise, and it's going to rise on the back of a rising gold price, which will have a dramatic effect on the cash flow. So this is a company whose assets are mainly in North America, so it's got low political risk, and the production should ramp up. Let's now go and have a look at part of their PowerPoint presentation. So obviously do read the cautionary notes, which basically tell you could lose all your money amongst other things. And we're going to look, so here we have where they're mining. The mine I'm talking about, which is going to be the big catalyst for the share price rise, in my opinion, is called Island Gold and Magino. Magino is the one where the production should ramp up. And here you see that they're saying that they expect, or they forecast, and forecast is not a guarantee, to mine 570 ounces of gold this year with a longer term production rate of 900,000 ounces, nearly double. Their all-in sustaining costs, according to them, are already very low at $1,425 an ounce, and is expected to drop by $250 to $1,175. Here we see a few parameters as to why they think they are better than all the other companies. First of all, you see the growth here in EBITDA, that's earnings before interest, tax, and depreciation. And on the so high growth, and on the other hand, you see the valuation. This is the EV divided by EBITDA number. They're much lower valued than many other companies. Symbol is AGI there, the orange line. Here we see one of the features that has made this company attractive. They say that the acquisition cost of the Island Gold and Magino mine was $1.3 billion, and they say the consensus net present value of it is $6.61 billion. So we won't spend any more time looking at that one, and let's move on to the next gold mining company.
Among the standouts is Alamos Gold, a North American miner known for strong financial discipline. Analysts highlight its lack of debt, expanding cash reserves, and ongoing production increases. The company's major catalyst is the development of its Magino project, expected to significantly lift output through 2027. Production is projected to rise from under 500,000 ounces to more than 1 million annually, coinciding with elevated gold prices. Alamos also operates primarily in politically stable regions, reducing geopolitical risk. Analyst models frequently show the company trading well below estimated fair value, with double-digit annual earnings growth expected for several years.
Here we are. The next company we're going to look at is called Equinox Gold Corp. Equinox Gold Corp. Let's go to the Simply Wall program and see what that's got to say about it. I'll scroll down to the, it's in the filter here. It's one of the few companies I picked out from these 20 companies, and we'll look at what Simply Wall's got to say as a starting point. They say that the company is trading 63% below its estimate of fair value, and they say that the earnings are forecast to grow by 38% a year. There are some negatives that you see here. Shareholders have been diluted, profit margins are lower than last year, insider selling over the last 3 months. Well, you know, every company has got negatives, and you have to balance the negatives with the positives. But that's, I'm not going to find a company with no negatives, otherwise the share price would be in the moon. What's the bullish case for Equinox? And we're going to look at the website in a minute. Equinox it merged with a company called Calibre Mining earlier this year, and that makes it the largest gold producer in Canada, or it's actually not the largest, the second largest gold producer in Canada, and one of the top 15 gold producers worldwide. The catalyst to push the share price higher is related to two of their mines. One, called Valentine Gold Mines, has just gone into production. The other one, called Greenstone, is ramping up and should go into production very soon. The company is expected to make a lot, or dig out a lot more gold next year than last year. So this year it's looking at 785,000 ounces of gold being dug up, and next year, 2026, it's looking at going towards 1 million ounces of gold. So there's your catalyst. Now let's have a quick look at the website of Equinox Gold, which is here, and it tells us that the good news is Valentine is in production. It's not profitable yet. That announcement about profitability should come next year, and that will be a catalyst to push the share price higher. It has, according to this, 7 operating mines producing, they've increased the figure to 850,000 ounces. And you see a few headlines here. Equinox delivers record Q3 production and revenue. Canadian gold production increasing, setting the stage for a strong 2025 finish and momentum into 2026. Let's go and have a look at their presentation. As always, read the cautionary notes, which tells you might lose all your money investing in this company, and this is not investment advice. Where are their mines? Well, you can see here it's 50% Canada, 13% USA, that takes us to 63, and then the remainder is in Brazil, Nicaragua and Mexico. That's about 1/3 of the total mines. And here they compare themselves with a couple of other companies, one of which we just looked at, which was Alamos Gold. Obviously, Equinox, for their own reasons, thinks that they have better multiples and better everything than other companies. Just scrolling through the here they're showing that their share price is only up 108% compared with, let's say, London Gold, which I did mention in one of my earlier videos 3 months ago, 6 months ago maybe. 6 months ago, I think it was. London Gold is up 993% this year. Let's hope that Equinox could do the same thing, go to 9 times what it's worth now. A little map of where their mines are. So that was Equinox Gold.
Another attractive candidate is Equinox Gold, which recently expanded by merging with Calibre Mining, positioning it among Canada's top producers. Its near-term growth is driven by 2 key developments: the Valentine Gold Mine entering production and the Greenstone project ramping up. Together, these sites are expected to push output toward 1 million ounces annually by 2026. Despite some recent share dilution and insider selling, analysts forecast earnings growth approaching 40% per year. Record quarterly production and rising revenue reinforce the company's momentum. With assets across Canada, Mexico, Brazil, and Nicaragua, Equinox is emerging as a globally diversified mid-major miner,